సార్ మార్నింగ్ మెసేజ్ పెట్టేశారు స్టాఫ్‌లో డిలీట్ చేయండి. అది కాదు డిలీట్ చేయండి.
వచ్చినారా?
Manishankar sir. Hello sir.
Yes sir. Yes sir.
I think Gurunatha Naidu sir thinks you can go on video off sir. Once sir comes you can.
Yeah, already yourself and sir both are in co-host only sir. I am waiting for the resource persons.
Okay.
Resource
Because
person
some
and Sudarshan sir.
Because Gurunatha Naidu, it is showing some background is showing. Sir, can you go it on, put it on off, sir? Off mode, video off.
Okay, sir, I can do it. No problem. I can keep moving. Yeah.
Good afternoon, sir. Srikanth, sir. Good afternoon. I think you are on mute, sir. You are on mute.
Yeah, now I'm okay.
Okay, sir. Welcome back, sir. Welcome back.
Thank you. Yeah.
Sudarshan sir is joining now, sir. In another 2 minutes. Sir.
Yes, sir.
Srikanth sir, your PPT is visible.
Oh,
Both
okay.
the
Thank you.
YouTube as well as here, sir. Both in Zoom as well as in YouTube.
Okay, great. So we all set to go.
Yes, sir. Yes, very clear.
Good afternoon, Srikanth sir.
Afternoon. Good afternoon.
Gunanet sir. Good afternoon, sir.
Sudarshan, good afternoon.
Good afternoon.
Still 10 minutes time is there. Exactly 3 will start.
Okay. We got exactly 10 more minutes to start.
Yes, sir. Yes, sir. Sir, Srikanth, sir, meanwhile, let me just seek a clarification. When you have shared with us that a lot of trucks are awaiting to unload this, especially crude oil trucks. When abundant raw material is available, why the price of petrol and diesel has not come down? Of course, the government levying heavy taxes and they are penalizing us. That's one way it is correct. Is there any other reason?
No, nothing else. The
Nothing
prices
else.
are very low at the Of course, they have climbed up a bit right now again from their lows in April. Then what happens is both the state government and the central government, they both get money out of it. And
Yes,
they
sir.
need money for development purposes.
Yeah.
So this is where they take it from.
Exactly.
Yeah.
Now, why I'm requesting you to just share your idea when our forex reserves are increasing like anything,
Yes.
and people are really suffocating without money. Even at this point, also we are paying 88 rupees, 90 rupees for petrol. It's painful. It's painful. But as you rightly said, it is a source for revenue to get income.
Absolutely, yeah.
They levy heavily.
So there is another way of thinking. They say that if you can afford a vehicle, then you should be paying tax. So in some way or the other, you end up paying tax. Right.
Of course, the scenarios are also changing now, sir. Who is paying more power bill and who is using more credit card? So based on that, they are going to levy taxes in future. Means I don't know where the real trend is going on. I don't know.
It will happen. That's my personal view that taxes will come down. It's just unfortunate that this pandemic came. Otherwise, we were all expecting prices to be going down. The taxes to be going down.
Good, sir, good. But I am worried because of this pandemic situation. The cyber crimes will increase. The scenarios are going to change. NPA accounts will be more, and more problems you are going to face in future, sir. Because it's not going to end very soon.
It's a different type of problems will crop up. Yeah, cyber crimes will crop up.
Yes,
no
sir. Yes.
So yeah, general crime rate has gone down because people are not on the streets. So and if someone steals, they get the thieves get caught very quickly because it's easy to find them.
Correct.
So it's a new different type. So everyone has to be very careful, especially when you click on something on your mobile. I'm very, very, very careful. It's a different type of crimes, right?
Recently, we have conducted one webinar on hawking, especially how you have to use your mobile devices consciously.
Yes.
To alert people, we have conducted one webinar with 350 participants. It was very nice.
Lucky. I wish I could have attended. Generally, especially if you have elderly people at home who have mobiles, they need to be cautioned not to answer calls. Not to answer calls at all. Because I'm basically a chartered accountant. So in accounting, we say, when in doubt, leave out. And that is what you have to, that is the rule that you have to use. Whenever the call comes, you can't know who it is. Just leave out because it's better to be cautious.
Right. Surprisingly, I came to know these culprits, they are targeting only above 60 age group because they are the people they can easily tempted, attracted, tracked very easily.
Very true.
Especially, sir, this particular Uttaranchal, Jharkhand, UP, some parts of Bihar, though literacy level is less, rate is less, they are well trained in these aspects.
Absolutely.
So more criminals are there in those areas only. They are targeting South India specifically.
and it's happening from it's not just in India, abroad also. Even in the developed countries, people are facing this problem. It's just not India alone. So we are finding this happening across the globe. Everyone has to be cautious.
Yes, sir.
So although your mobile is a boon, but you have to be very careful of it. Very, very careful.
Manishankar, how many are connected in YouTube? Manishankar?
Yes, sir. So one
How many
second.
are?
Sir, so far 25 people are watching, sir.
Okay. We'll start exactly by 3 o'clock.
Yes, sir.
Just now completed the participants 100 in the Zoom app, sir.
Yeah, yes, I've seen.
Then they are trying to join.
Correct.
No doubt, this session also more than 200 they may join.
Good afternoon to all participants. Srikanth Kaundine garu, good afternoon.
Good afternoon, sir. Good afternoon.
And all my dear faculty members, coordinators of today's webinar.
Good afternoon, sir.
Yes, sir, good afternoon. I am immensely happy, not only me, all the participants, faculty, we are really delighted, experienced, very nice information on commodity derivatives, sir. Futures of commodity derivatives, you have briefed, well said, very well connected with all the participants. Feedback, wonderful, sir. The way how you presented, how you have given suitable examples, how you have shown the calculation, how you have enlightened the aspects on commodity derivatives, really immense thing, sir. Immense. We are really impressed.
Oh, thank you. Thank you.
And one more request is, when you said afternoon you are going to share options, we are all eagerly waiting to listen to you, sir, to know many more things. And also we are fortunate because out of 5 exchanges, one MCX Vice President is with us to brief on these aspects. It is really our fortune, sir. No doubt in that. And also I convey my heartfelt thanks to my colleague, friend, Professor Sudarshan, who has very well tracked you, connected you, and brought you on this platform. Sir, I don't want to prolong, waste time, and let me invite you today's afternoon session to take over, sir. Please take over the session and carry on to make us to enrich more on options. Thank you very much, sir. Thank you.
Thank you. Thank you very much, sir. So we just to, before I get going, Mr. Sudarshana, when I myself, we are being in touch almost constantly. Yeah.
Yes, sir, sir.
It's our pleasure. It's my pleasure. Right, sir.
God gifted a friend to all Vidya Niketan family, sir.
Yes, absolutely. This particular session on options is going to be much easier for me to roll it out because when we talk about commodity options, a lot of it, the background which goes into it, understanding the commodity itself, that has already been taken care of in the morning session. So it becomes much more easier for me to get into this particular commodity. Now, commodity options. Now, one thing I want to say that if any of you are already familiar with stock options, nothing really changes. The only thing that changes is that the underlying changes. In the sense, if I am buying an options contract on, say, Infosys or Tata Motors, now here I'm buying a contract on gold or, it can be a potato or whatever. The point is the underlying changes. Nothing else does change. And a little bit more on options as we go along, because I want to, I'm going to touch upon is I'm just going to basic options, a bit of Greeks, strategies. I'll compare futures and options as well. Okay. Now, remember this particular slide in the morning that we talked about, the interlinkages. We talked about exactly the same thing. Now, nothing changes because I am looking at the price of a raw material and it is affected by all those things we talked about in the morning, like the interest rates and currencies and whatever. Because what am I really doing? I am still buying something in the future. The only thing is the instrument is changing. Earlier, the derivative instrument was futures, and now the derivative instrument is options. So it's basically what we are trying to do is we are doing exactly the same thing, but we are doing it using a different financial instrument. To be more accurate, a derivative financial instrument called options. Now, again, the commodities are the same, right? So nothing changes again here. And the commodity prices are impacted by exactly the same things. So if I buy, whether I buy a futures or whether I'm buying an options contract, the value of that particular underlying is again impacted by exactly the same things, interest rates and weather and demand supplies and all those things that we talked about. And so let's talk about what are actually options. Now, the difference between options and futures, I'll come to it in a few minutes, but in options, you must remember that what you're really buying is a right. It's a right to buy. That is what you're buying. you're buying a right to buy something in the future, okay, at a pre-agreed price, a pre-agreed set price. And to buy this right, I have to pay a little bit of money. Okay, so the buyer of a right has to pay money, but the person who is buying this right has no obligation. He only has a right, but no obligation to buy. And that is when you have an obligation, a right to buy, we call it a call option. When it is a right to sell, we call it a put option. But you must remember that if I'm buying a right to do anything, if I'm buying a right to buy, then there's someone on the other side who is accepting that little bit of money from me, and he may be obligated to sell if I decide to exercise my right to buy at a date in the future. It will become much more clearer as we go ahead. But at this moment, I want you to understand that in options, the buyer of an option is buying a right. A right to buy is called a call option. Right to sell is called a put option. And the person, but of course, when he buys this right, no obligation. Now, there's one more little feature that comes in options, what we call strike price. So in options, the exchange, when it designs the contracts, it gives various strike prices. And between the strike prices, there is a difference between the strike prices. So you can have a strike price of, say, 50,100, 50,200, 50,300, 50,400. So there's a gap of 100 rupees. Or you can have a different kind of a contract where the difference might be a 50 rupees difference. So you can have 50,050, 50,100, 50,150. Now the point here is these prices that I'm mentioning, these are called strike prices. And on each of these strike prices, people can pay money called a premium, and they can buy a right to buy or buy a right to sell. So that is how the call option and put options are decided. So we have a call option, buyer of a call option, and there's a seller of a call option. Similarly, for a put option, there's a buyer of a put option, and there is a buyer of a put option and a seller of a put option. Always the buyers pay money to buy the right. And on a commodity exchange, when you're buying this right, that money that you pay to buy this right, you pay it immediately upfront. And this money gets transferred to the seller of the option on the opposite party. The money gets transferred into his account at T+1. That means if I trade today, tomorrow morning he gets this money. This money is called the premium. And this premium money which he gets into his hand, that money is gone. So if the buyer of a call, buyer of a put pays the premium, he will never get it back again. Compare it with futures. In futures, the money blocked is called margin money, but the margin money is always returned. Whereas in options, the money is never ever paid back. Once it leaves your account, it will never come back again. Now, a call option, so basically there's a definition of a call option that I'm sure every textbook will have that. We just say call option gives the buyer the right, but no obligation to buy. Now, what exactly does this mean? It just means that, for example, if I pay you 10 rupees now, and I buy a right to buy something from you at 100 rupees after 6 months. Now, after 6 months, I have a right to buy at 100 rupees. And I have paid you 10 rupees now as premium, and I have bought this right to buy from you at 100 rupees. If after 6 months, the price of that commodity is 500 rupees, then I will exercise my right to buy, and you, the person who has taken the premium, will be obligated to sell it to me at the pre-agreed strike price of 100 rupees. Now, if after 6 months, the price of that commodity drops, if it drops to say 50 rupees, now I have a right to buy at 100, market price is 50. Now, if the price drops, then I will not exercise my right because I can buy it in the open market at a lower rate. And hence, by doing so, I will walk away from the contract and I will lose the premium that I've paid. Now, that is what a call option is about. In a put option is exactly a similar way. I might be a farmer. I could be a cotton farmer. I've paid you 10 rupees now, and I buy the right to sell something to you after 6 months. Let's say at 500 rupees. So I bought this right to sell something to you at 500 rupees after 6 months. And for buying this right, I've paid you a premium. I paid you 10 rupees premium. Now, what can happen after 6 months? After 6 months, if that commodity is available in the market at a very high price of, say, 800 rupees, then I will exercise my right. No, I will not, because I will be happy to sell it in the open market at a high price. However, if the price drops to, say, 200 rupees, then I will exercise my right to sell it to you at the pre-agreed strike price of 500 rupees. And you on the other side will be forced to buy it. Now, this is where the exchange comes in. Exchange guarantees the trade. In other words, in such a case, the exchange will ensure that the other party will abide by the contract to buy. He has to abide by it because he has taken the premium. Now, we have derivatives which can be broken into OTC derivatives and exchange traded derivatives. Now, OTC derivatives are swaps, forwards, and options. Okay, so we have OTC options. Similarly, on the exchange side, we can have options and futures and options on the exchange side. On the OTC side, we have few options, swaps, and forwards. Now, you might notice that options are on both the sides. So options can be OTC and options can be exchange traded. What really is OTC? OTC means that these are negotiated trades. In OTC market, there are both the parties who can see each other, they can negotiate with each other, they can decide the price, decide the time, they can have customized contracts. That is what an OTC derivative contract is. For example, if the government of India decides to buy crude oil from, let's say, the government of Kuwait in the Middle East. So both the parties will sit across a table and negotiate that at what price they will buy, what quality they will buy, and when the payment will be made, how the payment will be made. They will negotiate when the delivery will take place. And because it is happening in the future, that means they will negotiate to deliver a tanker of crude oil at not one, maybe 5-6 tankers of crude oil, one tanker to be delivered at JNPT in Mumbai, one at Visakhapatnam port, one at Chennai port. So they will negotiate. They say, I want the first delivery in the month of September, the second one in October, third one in September, November. So they can actually negotiate this. So this is an OTC example of an OTC contract, which is negotiated. It is a derivative because I'm buying in the future at a price that I think is going to be the price. Both the parties are agreeable to it. And hence that is OTC. And exchange traded, we launch a contract. The buyers and sellers are anonymous when they trade on a laptop. The buyer doesn't know who the seller is. The seller doesn't know who the buyer is. And at the end of the contract, it's only then that it is revealed, depending on who is still in that contract. If someone has squared up his position and left the market, then he's out of the market. So whoever is remaining, they are matched by the exchange. And that's when the final settlement will eventually take place. We'll talk on that later. But at this moment, I want you to understand that there are different types of options contracts. So we have American options. We had European options, plain vanilla calls and puts, exotic options. Now, options, like I said, they're negotiated. So if they are negotiated, we call them exotic options because you can make all kinds of specialized contracts, and we call them exotic option contracts. They're very, very specialized to both the parties to the contract, and they're called exotic. American options are contracts where you can exercise the option at any time during the life of a contract. In India, we do not have American option contracts. What we have in India and all the commodity exchanges and also in the stock markets is European options. European option contracts will expire on a specific day in the future. Now, don't get me wrong here. If I enter this contract, I can always come out of this contract by taking an opposite position. But if I remain with the contract, then the contract will expire on a pre-agreed day expiry date, which is always in the future. So hence, the contracts we have in India are European option contracts, which will exercise on a particular date. And if anybody wishes to exit the contract, you can always take an opposite position and exit the contract. Now, there are a couple of things in this options, some few terms that we need to understand. One is the options price. Yeah, when we talk about the value of an option or the options price, we are actually talking about the premium we are paying to buy the right. So the options price is the premium that I pay to buy a right to buy. Call option, the premium I pay to buy the right to sell, a put option. So, and it is a negotiated trade, and hence on the other side too, the person who is accepting the premium, he may demand, obviously he will demand a higher premium, and hence on a trading terminal, you will see people who will be trading at different prices, and they will say, I want so much money as premium, or I want more money as premium, less money as premium. They won't be saying it, but they'll be punching the value at which they wish to enter the contract. Okay, that is the options price. Every contract will have an expiry date. It is the date on which the contract will come to an end. When the contract comes to an end, then, only then, the physical delivery, the entire process for delivery will start. Now, I'm talking about a process for delivery because it will become a little complex when we come towards the end. Now, strike price. So like I said earlier, every contract will have a number of strike prices. For example, the gold contract that the MCX has, we have got 31 strike prices, and between two strike prices, there's a difference of 100 rupees. So there's a 100 rupee interval between the different strike prices. We have base metal contracts where the interval is much lower. We have 15 strike prices, and the interval is 50 rupees interval. So the point of the matter is that we have strike prices at which you can trade. Then we have open interest. Open interest means how many people have actually gotten a position in that particular contract. Now comes to an important part called moneyness in options. Moneyness in options is like, am I in the money, at the money, out of the money? This moneyness actually defines the value of the option. It defines as to how much premium I have to pay. So let me give an idea. So if I pay you 10 rupees now, and I buy a right to buy something from you at 100 rupees in the month of December. So I have a right to buy at 100 rupees in the month of December, for which I have paid 10 rupees now. Tomorrow, if the market price of that same commodity, that means in the open market, if the market price is 150 rupees, I have a right to buy at 100, and hence I am in the money. How much in the money am I? I'm 50 rupees in the money. I have a right to buy at 100. Market price has already become 150. So I am in the money, worth how much? I'm in the money, 50 rupees in the money. That is in the money. I have a right to buy something from you at 100 rupees in the month of December. And if the market price is also 100 rupees, then I'm at the money. No gain, no loss. I'm still at the same. And I'm still waiting that between today and the expiry date of the contract, I want to see which direction the price will move. Out of the money. I have a right to buy something from you at 100 rupees in the month of December, but the price is already 40 rupees in the market. So will I buy from you at 100 rupees? Of course, I will not buy from you at 100 rupees because the market price is already 40 rupees. It's come down. So I am out of the money as of now. Now coming to what's the importance of all this? The importance of this is that when I'm trying to enter at a particular strike price, where that strike price is out of the money. If it is out of the money, then I will be paying a lesser amount of premium to buy that contract. If I'm in the money, the more in the money I am, the more premium will be demanded by the opposite party, that the writer of the options. So the in the money, out of the money, at the money is a very important element of options trading. It needs to be understood thoroughly. It has an impact on the price at which you will enter the contract, what we call options price, and the actual money value as to how much in the money I am or how much out of the money I am in rupee terms. That is called intrinsic value. So intrinsic value says I am 125 rupees in the money. I am 60 rupees out of the money. The minute you put a value to it, that value is called intrinsic value. So options may be either physically settle or cash settle, yeah, whatever you can be settled. And cash settlement involves settling the difference between the strike and the spot price at the point of exercise, which is at the end. And buyers may either source delivery at expiry or separately. Options would simply offer price protection. Okay, that is just the theory part of it. Now here I just want to again make sure, because some of you might be new to options. So let me just very quickly make sure that we understand what I've been talking about. So look at this underlying futures or market price. The contract value is above or below strike price. Yeah. So look at this 18th August, which is today. On 18th August, Mr. Z, he buys a 31st December contract, strike price 45,000. So so he buys a call option 45,000 for which he pays 200 rupees. Now what is happening here? He's paying 200 rupees to buy the right to buy something at 45,000 rupees on 31st of December. That is what it means. And that 200 rupees is called a premium. Now on the date, I think I should change the date. I'm very sorry. I should have changed the date. I should have made it September there. Let me do it right away. Where am I? So this should have been September. Otherwise, it'll get a little confusing for everybody. Because we keep doing these programs all the time, then I need to update my PPTs. I think I missed out on that. All right. So what is basically saying is that I have a right to buy at 45,000, for which I've paid 200 rupees. And I've done this. I bought this contract today on August 18. And by the time we reach 4th of September, if the price on 4th of September is 50,000 rupees, then I have a right to buy at 45. So I'm in the money, because remember, I will exercise my right at 45,000. And exchange will guarantee the trade at 45,000. How much in the money am I? I'm 5,000 rupees in the money. And hence that 5,000 rupees is called intrinsic value. Suppose by 10th of September, the prices move. If the prices have now changed and become 42,000. Now what prices are these? These are market prices. Now, if the market prices become 42,000, I have a right to buy at 45,000 in December. Already on 10th of September, it's 42,000. And hence, I will not exercise, because if I exercise, I will be forced to buy at 45,000. I will not exercise. I have no obligation, because I'm the buyer of a call. I don't have obligation to buy at 45,000. I can walk away from the deal. Why? Because as far as this contract is concerned, I am out of the money. How much out of the money am I? I'm 3,000 rupees out of the money. Okay. I don't know if I still wait further between 10th of September and 31st of December, things might change again. And I might again become in the money. So that is the point of the options trading. In options trading, you must trade at a price that you think is going to be the price on a date in the future. And then between today and that day, the price could go every day. It can keep changing. And if you think that you have got a bad position, you can, of course, come out of that contract. So look at this other side. This is the put option side. Actually, there are 4 such situations, but I'm only because of paucity of time, I'm only going to take two sides of it. So this is out of the money for a put option. So what is a put option? So on 18th of August, Mr. JP sells a put option. What is a put option? Right to sell. A right to sell at 60,000 rupees. He has bought this right. For buying this right, he has to pay some money. He has paid 500 rupees premium and bought this right to sell at 60,000 rupees on the 31st of October. Now, by 31st August, the price in the open market is 55,000. He has a right to sell at 60. Market price is 55. If Mr. JP sells in the market, he'll only get 55. But if he exercises his right on the exchange, he will get 60. So he is in the money. How much in the money is he? 5,000 rupees in the money. Right? So this is how we look at it from the put side, from the seller's point of view. And on 31st of October, the date when the contract comes to an end, on the date when the contract comes to an end, the underlying price is 75,000 rupees. Okay, so basically we are saying that the price have changed. So by 31st of October, the day when the contract came to an end, the price is 75,000 rupees. This gentleman has a right to sell at 6,000 for 60,000. The price has become, market price is 75,000. So he will not exercise his right. He'll be happy to sell in the open market at 75,000. As far as the contract is concerned, he's 15,000 rupees out of the money on the date when the contract expires. So he will just walk away from the deal. And as far as the other party is concerned, he'll be very happy. The only money they will make is the 500 rupees profit. That's all they will make. So how much money is expected to make in this particular situation? He has lost 5,000. He will sell in the open market. So in this case, 60 minus 75. So that is, so he'll make 75,000 rupees minus 500, which is already paid up front. So he's actually made 74,500. So he'll end up making 74,500. So this is the way we need to know whether somebody is in the money or out of the money. Depending on how much in the money you are or out of the money you are, it will depend on how much premium you will be happy to pay or how much premium the other party is happy to receive. Now, let's understand the basics a little. Now, this is a basic as far as a call option is concerned. So what exactly is a call option? A right to buy with no obligation. So look at here what is happening here. I'm just these 3 points here. I'm only interpreting them. So I pay you 5 rupees now. I'm only paying you 5 rupees now, and I'm buying a right to buy at 105 rupees per kilogram. So this could be a price of 1 kilogram. So I pay you 5 rupees premium now, and I buy the right to buy at 105 rupees per kilogram. When? After 1 month. So after 1 month, what can happen? Now that is what is called a payoff table. So this on the right-hand side is a payoff table. After 1 month, the price could be 100 or it could be 120. This is the market price. I have a right to buy at 105. If the market price after 1 month becomes 120, then I will exercise my right and I will buy from you at 105 rupees. How much money have I made? I've made 120 minus 105, which is 15 rupees, plus subtract the 5 premium that I've paid up front. So, and I end up making a profit of 10. So by exercising my right, I make a profit of 10 per kilogram. Remember, some of our copper contracts are 2.5 metric tons. So it's a lot of money really that you're talking about. Now here, if you see, after 1 month, if the price falls to 100, I have a right to buy from you at 105. If the market price is 100, then I will not buy from you. Why should I pay 100? Why should I buy from you at 105, which is the pre-agreed contract price, when I can buy from the market at 100? So I will walk away from the deal because I have no obligation. Being the buyer of an option, I have no obligation to exercise my right. So what is my loss? My loss is the premium of 5 rupees. And hence at different strike prices, at different market prices, I will have different scenarios as to how much money I'll make. So when I plot this in a graph, as you can see on the left-hand side, this is the kind of a graph that I will get. What it shows is that I've paid you $5, the red -5 you can see, and hence it is showing negative. And any time after 105, when the market price moves up beyond 105, the higher it goes, the more money I make. So for example, if the price is 120, then if I just draw a vertical line here and move across, then I make a profit of 10. That is what is basically trying to show you. Now, this is an example of a buyer of a call, but you should also understand from the point of view of the seller of a call, the person who accepted the 5 rupees. For him, the position is exactly the reverse. Now here, if I have to interpret this information, it's basically saying that I take 5 rupees from you, and I may be obligated to sell copper to you at 105 rupees per kilogram. So he's the other party. Yeah. So like you have got a buyer and seller. So this is a seller of a call option. So this guy who has received the 5 rupees, he may be forced to sell at 105. Now, if the price is 120 in the open market, then the person on the other side, the buyer of a call, will exercise his right. And whereas in his case, he made 10 rupees profit, in my case, I end up losing 10 rupees. In other words, the seller of a call option, his position is a absolute mirror image. In fact, this chart that you can see on the right, on the left, that chart that you can see is, I'm going back again, you will see that it is a mirror image of this particular of this particular chart. So I can have a look at it again. It's a mirror image. What it's basically saying is that if prices go beyond 105, 110, then the buyer of the call option will not exercise his right because he will be happy to buy in the open market. And you, as the writer of a call option, will be happy. So if the prices fall, he's going to be very happy with the profit of 5. But if the prices rise, then he will suffer an unlimited loss. So as the prices start going up, the buyer of a call option will exercise his right, and I, as the writer of a call option, will be facing a loss. So this is the two scenarios from a call option. So call option buyer, call option seller. So there are only two positions here. And when you come to the put option, we again have two positions. One is buyer of a put option. So what is the buyer of a put option? Let's interpret this information. Buyer of a put option has got the right to sell. Now, by paying 5 rupees now, I'm buying a right to sell a tin contract for 30 rupees per kilogram. So I have a right to sell at 30 rupees per kilogram. And for buying this right to sell, I'm paying 5 rupees. Now, after 1 month, the price could be 40 or it could be 18. Now, if the price is 40, I have a right to sell at 30 per kilogram. If the market price is 40, then I will be happy to sell in the open market for 40, and my loss will be limited to the premium that I've paid. However, if the price drops after 1 month to 18, if the price drops to 18, I have a right to sell it to you at 30, and I will exercise my right and sell it to you at 30. How much money do I make? 30, which is, because that's the right at which I will exercise. 18, which is the market price. That's the price I would get if I had to sell in the market. The difference between 30 and 18, less the 5 rupees premium that I've paid, and comes to 7. And hence the maximum profit I would make is 7 rupees here in this particular case. Now, I can depict this by way of exactly the same thing. I can take the market prices, I can take the payoffs, and I can plot it in a graph. And this is what I'm getting, this particular kind of a chart I will get. It's basically saying that at prices below, I will exercise my right and I will make a bit of profit. And prices go higher because I have a right to sell, but no obligation. I have a right to sell at 30, but no obligation to sell. So if the price becomes 40, I will not exercise my right, in which case I will walk away from the deal and I will suffer the 5 rupees, as the premium that I paid as my loss. So I'm very sorry, it says 10 here. It should actually be 5 there in red, but don't worry. Let's look at the other option. This is the opposite side. Now, again, this is a mirror image. This is the seller of a put option. The seller of a put option is a person who may be forced to buy. He may be forced to buy. So buyer of a put option has a right to sell. The seller of a put option he may be forced to buy. At what price? So if I look at, he has received the 5 rupees premium, and now he may be forced to buy at 30 rupees per kilogram after 1 month. If the market price is 40, then the buyer of a put option will not exercise his right because he'll be happy to sell at 40 rupees. He'll be happy to sell in the open market. So he will not exercise, in which case I'm sitting on a profit of 5. If the market price falls to 18, then the buyer of a put option will force me to buy at 30 rupees. Market price is 18. I will be forced to buy at 30. I have received 5 rupees premium, all right, but then I have made a loss of 7. So it's a mirror image. Whatever happens to the buyer of a put option is exactly the reverse is happening to the seller of a put option. Now, the point of the matter is, in options, there are only these 4 situations. Buyer of a call, seller of a call. The buyer of a put, seller of a put. These are the only 4 situations that you need to come to grips with when you want to trade in options. The other thing that you need to understand is some of the general wordings that we use. Like when we say buyer of a call option, buyer of a put option, buyers are basically holding right to buy or right to sell. And hence the buyers are often called holders. So we call them holders of options because they hold the right to buy or hold the right to sell, depending on whether it's a call or a put. Similarly, on the other side, the seller, we call him writer. So they're often called writers of a call option, writers of the put option. The writers are those people who receive the premium. Now let us compare. Let us compare futures with options. What is the comparison with futures and options? Now, first of all, futures are exchange traded. Options are both OTC and exchange traded. But on a commodity exchange, the options that we have are exchange traded options. But do always remember, options can also be OTC, OTC options. And hence, I just want to tell you, because many of you might refer to books, or you might go to internet and try and download material on options. So I want to caution you that whenever you're trying to understand options, make sure that you segregate. In fact, most of the books that you read will also have this segregation between OTC options and exchange traded options. And what is offered on an exchange like MCX are exchange traded option contracts. So what do you mean by exchange traded options? These are standardized contracts. OTC contracts are customized. They're customized between the buyer and the seller. Exchange traded are common, standardized contracts which can be traded from anywhere in India, right from Kashmir to Kanyakumari. As long as you have a laptop or you have a mobile phone, you can trade options, just like you can trade futures. In futures, we have margin money. In options, we have premium. Do recall I had said, how do you differentiate what exactly is a derivative? It has got three characteristics. First, it is a value in the future that I decide now. The second, that I pay a small amount of money to get into that position. That is what a derivative is. Finally, all derivatives expire on a date in the future, on a contract date. But the difference is, in futures, we call it margins. In options, we call it premium. The other difference is, margin money always comes back to you when you square up your position. In options, the premiums, once paid, is gone. You never get this money back. So that is one big difference. The other one is on futures. The futures price reflects the holding cost and market perception. Remember, we talked about in the morning, I showed you that chart. What exactly is the futures price? It is spot price plus holding cost plus or minus the perception. Now, the entire price of the commodity is impacted by the futures. So when I talk about futures price of gold, I will say the futures price of gold is, say, 40,000 rupees. Yeah, so that is my view. Now, similarly, in options, when you talk about futures price, we are talking about 100 rupees, 200 rupees, or maybe 300 rupees. So what am I talking about? In options, we are talking about the premium that I'm going to pay to buy a right to buy. And so the point here is that whatever influences the price of a futures, the same thing influences the price of an options. But remember, it influences the price of the premium. So for example, I'm willing to pay you 100 rupees to buy the right to buy something in the future. And then suddenly I get this information that the solution for COVID-19 has been found, a vaccine has been found. And now the prices might be falling, in which case I'm now going to pay not 100 rupees to buy the right to buy at 40,000, but now I'm willing to pay you only 25 rupees to buy the right to buy at 40,000 rupees in the future. The point is, the price remains the same, the price at which I wish to buy, but only thing is the right to buy now the differential is that I'm paying less amount of money to buy that same right. So I'm buying exactly the same right, but at a lower cost. Or it could be at a higher cost if I find the market is moving in a different direction. But to compare the futures and options, futures prices are impacting the total price. In options, it is the changes in price of commodities are impacting only the premium value. Now in futures, we can square up the position anytime we want. In options, we can do that. But remember, the buyer of an option, buyer of a call, buyer of a put, he has no obligation. He has paid a little bit of money called a premium, and he has bought a right to buy. So he can walk away from the deal or he can exercise. That's it. There's no point for him. He cannot undo his position. That money has already left and it has already been paid to the other party. The person who can reverse his position is the seller. The writer of an option can undo the position by taking an opposite position. Yeah. So for a buyer, he has obviously no other obligation. His obligation has already been taken care of at the point when he paid the premium. So the question, last point here is, what affects futures prices and what affects options prices? The answer is the same things, because we have to look at the underlying. What is affecting the underlying price? So whatever is affecting the underlying price for futures will affect the underlying price of options. So I'm sure you all remember this particular slide we talked about in the morning, what affects commodities. It, in fact, is exactly the same slide that I showed you in the morning when I was talking about futures. Only difference was the heading. The heading at that time said factors affecting futures prices. That is what the heading was. Now I'm saying factors affecting premiums. So what factors are affecting premiums? Currencies, geopolitics, economic factors, yeah, recessions, taxation, yeah, statistical releases, demand supply scenarios, inventory levels. They all have an impact on premiums. And of course, not to forget COVID-19 pandemic. It will also have an impact on how much premium you're willing to pay or how much premium you're willing to receive if you're a writer. And so the impact is exactly the same things are impacted. Only difference is in options, it is impacting the premiums. That is the main difference. The option premiums are influenced by many things. So for example, the premiums are impacted by changes in the underlying. I go back again. These are the changes to the underlying. These are the points which are impacting the underlying. So, and hence the first point here is talking about exactly the same thing. Price changes in the underlying, which is based on spot, physical market, futures market, and so on. And what is affecting all this? This is impacted by all these points that I mentioned here. And it is impacted by the strike price. So whether I'm in the money, at the money, out of the money. Now, so if premiums are influenced by that. If I am at the money or in the money, then the premium that I have to offer would have to be higher than if I am out of the money. So if I'm out of the money, then the premiums which will be offered will be lower. If you're in the money, it'll be higher. Now, of course, it depends on who you are. So if you're a buyer of a contract or a seller of a contract. If you're a seller of a contract, then you might demand a higher bit of a premium out of the money as well. Now, other thing that impacts the premium is time until expiry. So for example, if I have a December contract and I'm sitting in the month of August, I know it's easy for me to predict what the price is going to be in the month of December as compared to if I had been in the month of January. Now, the minute I come closer to December, let's assume that I'm in the month of November and this just about, say, 25 days before the contract will expire. The closer I am to the expiry date, it becomes easier for me to figure out what the expiry price is going to be. Yeah, I'm not saying it is absolutely simple, but it is at least easier as compared to when I'm sitting in the month of August. And hence, time, how many days are remaining until expiry will also have a bearing on the premiums. Yeah, so premiums will also be impacted by time until expiry. Other one is volatility. What exactly is volatility? Volatility is prices going up and down, very, very, very volatile price movements. Volatility is basically, in another word, I can call it risk. Very risky, very volatile, highly volatile, very risky price. And the more the risk, then the higher the premium demanded. Yeah, so volatility is also has an impact on the premiums paid, okay, and the premiums received. Other one is risk-free interest rate. So interest rates also have an impact because after all, I'm offering money called a premium to buy a right, or I'm right to buy or right to sell. And hence that money has got a value. So money value is impacted by interest rates. So interest rates decide as to what is the cost of capital, cost of money. And hence interest rates also have an impact on what the premium is going to be. So if interest rates go up, then they have an impact on whether I pay a higher premium or a lower premium. So we can look at this in a different point of view. So for example, here, this particular chart will tell you about factors impacting the premiums. So for example, here, if I'm talking just now, like I was just speaking about time until expiry, how many days for the contract to expire. Now, if the number of days is more, when you're comparing in a call prices will it'll be higher. Yeah. So and when the time expiry number of days are more in a call, in that case the premiums will be higher. And when it is in a put, it will again be higher. So both it will be higher. Whereas if the number of days decrease, then you will see that as the number of days are decreasing, then both for call and put, you'll find that the premiums will start, there'll be pressure on the premiums to be lower. Okay. Similarly with underlying, what is the underlying price? What is the price of the commodity in the open market? So if the price in the open market starts increasing, then in a call, a right to buy, then you'll find that the premiums will start going up. In the put, right to sell, it will start going down. Whereas if in the underlying prices, that means the prices in the spot market start decreasing, then it'll be exactly the reverse. So this particular chart, it really tells you in what direction you can expect the premiums to move, given changes that are happening, various factors such as underlying prices, time to expiry, volatility, interest rates, strike prices. Now, just to bring it into context in connection with the futures market, do remember that in the futures market as well, all these factors come into play. Only thing is, we don't have it in this particular fashion. You know, these are all called Greeks. So we can look at it from the Greeks point of view. So when I'm talking about changes in underlying prices, this first point here, yeah. So that changes in underlying prices is called a delta. Yeah. Changes in volatility is called a vega. Changes in time is called theta. Change in interest rates is called rho. In fact, when you look at derivatives like futures, options, swaps, and forwards. So these are the derivatives. Now, amongst these derivatives, options are always considered to be top. In a sense, options traders always hold themselves as something very special because there are so many things that can be done with options. They're considered to be a little more sophisticated. Options are always considered to be sophisticated, and hence they have brought in some bit of concepts of Greeks into it. It's nothing new, nothing to be frightened about. It's just that they have garnished the entire topic with some new kind of vocabulary called Greeks. So these delta, theta, vega, rho, these are all Greek words. Basically, like, you know, it's not very complex. For instance, easy to remember also, change in volatility. We call it vega. Remember, it's V for volatility, V for vega. Change in time is called theta, T for time and T for theta. Change in interest rate, change in rates, rho. Yeah. And hence, change in the underlying price, we call it delta. And the rate of change of delta, we call it gamma. And these are sort of formulas here allowed here. And you can also bring in something called very sophisticated kind of formulas, which can be brought in, what we call, oh my, why am I forgetting that? There is this, if I get back, just give me a minute, it's just missing my mind. But there are sophisticated formulas which can be run on your computer in Excel sheets. And what they do is they will help you to arrive at possible premiums that you could offer on a trading terminal based on changes of any one of these factors. Yeah. And hence, we call this Greeks. So Greeks are nothing really. We use exactly the same factors in futures. Only thing is, futures are not as sophisticated as options. In options, we have the same things. We have christened them as Greeks. That's the only difference. Yeah. And we use Greeks for making these calculations as to how much premiums we can offer. So let's look at option strategies. The various kind of strategies that can be offered. Now, by the way, when you talk about strategies in options has got thousands upon thousands upon thousands of strategies. Also, you have to remember one thing. Strategies is one thing to know the strategy. It's a second thing to learn the ability to implement that strategy. And you have to remember that these strategies, because the market is very dynamic and things in the market are changing all the time, and hence oh, by the way, it just got that the word I was looking for was Black and Scholes model. Yeah. So you can use go back again. Here you can use Black and Scholes model to using all these factors to calculate the premiums. We call it Black and Scholes model. Okay. Now, what I was just saying here was the strategies. The strategy, thousands upon thousands of strategies, but you should have the ability to fine tune the strategy. So even if you have a strategy in place, that is not the end in itself. You should have the ability to modify the strategy, not only when you're implementing it, but also once you have implemented it, you may get an opportunity at times to redefine the strategy. And that is when an options trader considers himself an expert. Once he's able to do that, then only then he can say, yes, I am an expert. And we are talking really about exchange traded options, because in a OTC options contract, you're locked into the strategy. You can't do much about an OTC option strategy. But in an exchange traded options contracts, you have that flexibility to modify an existing strategy. So let's see some of the strategies that I'm going to talk about. I'm going to talk about a protective put strategy because that is a hedging strategy. So let's see how this particular works, how this particular strategy works. So let's see what is happening here. Now here, I'm looking at gold. So assuming I have bought gold at 45,000 rupees. So I have bought the gold at 45,000 rupees, and this gold is lying in my godown, in my vault. Do remember, bullion is not kept in a godown. Bullion is always kept in a vault. And in a godown, you keep other things like base metals or agri commodities. They are kept in a warehouse. And here I've got gold, which is lying in a vault, and I bought it at, although it says 45,000 rupees, this is 45,000 rupees per 10 grams. I may be having 100 kilos of gold. Yeah, I may have bought 50 kilos of gold, and this gold is lying in my vault. I had bought it physically at 45,000 rupees. But the point is, I want to hedge. What am I hedging against? I'm hedging against price falling, because if the prices fall, then I'm going to suffer a loss. I will have to kick myself and say, hey, why did I buy it at 45,000 rupees? Why was I not able to anticipate that the price is going to fall? So here is where the exchange comes in handy. The exchange contract comes in handy. So I have bought the gold at 45,000, and the price after say 2 months can be anything. The market price could be 44,700, 44,800, or it could be 45,300. I purchased it at 45,000 rupees. Now, after say 3 months, if the market price is 44,700, am I happy? Of course, I'm not happy. I bought it at 45,000. Market price is 44,700. So I'm unhappy. How unhappy am I? So I am 300 rupees unhappy. I bought the commodity at 45,000 and the market price is 45,300. Am I happy? Yes, I'm happy. I'm happy that I bought it because the price has gone up to 45,300. And hence, how happy am I? I am 300 rupees happy. So this is exactly how the payoff. So what are you seeing right now? What you're viewing right now on this slide is a payoff table. So here is a payoff table, which is showing me that at prices above 45, I am happy because I bought it at 45,000. If the prices fall, I am unhappy. So what I can do to hedge my position is that I can buy a put and buy a put at 44,900. What is a put? If I'm buying a put, what am I doing? I'm buying a right to sell. I'm buying a right to sell at 44,900. So I have a right to sell at 44,900. If the market price drops to 44,700, will I exercise my right? Yes, I will. I will exercise my right and sell it to the opposite party, to the writer, at 44,900. Why? Because if I go to the market, I will only get 44,700. So I will exercise my right here and I will sell it at 44,900. And the exchange will guarantee that trade and I will be able to sell it at 44,900. Do I make a profit? Yes, I make a profit. How much profit do I make? 44,900 minus the 44,700, 200 rupees profit. However, if the market price drops, the market price goes up to 45,300. Will I exercise my right at 44,900? what is a put? Right to sell. Will I sell at 44,900 when I can get a better price in the market at 45,300? I will not exercise my right. At all these higher prices, I will not exercise my right. And the payoff table will look something like this. So basically what we are saying is that if the market price is 45,200, I have a right to sell at 44,900. I will walk away from this particular contract because I am not obligated as being a buyer of a put. I'm not obligated. I only have a right to sell at 44,900, and hence I will not exercise my right. Instead, I will go into the open market and sell at a higher price. I will not, and hence, as far as the contract is concerned, I will not exercise my right. Net, this is the kind of a situation I'll have. Of course, do remember that I have not bunged in the premiums, because for buying this right, I may have paid a premium. But let's not worry about the premium right now. Let's understand the principle of hedging. So what is really happening here? What basically is happening is I have bought this commodity at 45,000. It is lying in my vault. If the price goes up, I'm happy. If the price goes down, I have locked my losses to 100 rupees per 10 grams. For every 10 grams, yeah, I have blocked my losses. The maximum loss I'll make is only a 100 rupees. And hence I've protected myself, and hence this strategy is called a protective put strategy. So I've protected my losses to 100. If I wanted to cut this down further, then I would have probably traded at a different strike price, which would have been closer to the 45,000. Okay, this if I take the market price and if I take the net price and I can plonk it in a graph, you get a chart of this nature. But basically understand the payoff table. That is more than sufficient. Now I'm coming to a different kind of a strategy. It's called a straddle. So what exactly is a straddle? Now straddle is a combination strategy. In a straddle strategy, you are not hedging. It is not a hedging strategy. It's a strategy for the retail community, the retail market. They can get into a straddle. Now in a straddle, I am buying a call and I'm buying a put. Now do remember that no one is buying a physical commodity. You don't need to have a physical commodity. I don't have an intent of buying the physical commodity. I don't have an intent of selling a physical commodity. All I'm interested in is buying a call and buying a put at the same strike price and expiry date. And expiry date, that means I pick a contract which is expiring on a particular date. So for that one contract, I choose one strike price, and at that strike price, I buy a call and I buy a put. Why do I do that? And why do we call it a straddle? Because it is straddling across a call and a put. It is straddling across different price movements. So we'll see with numbers how this looks. So let's look at this, how this straddle works. So you can see what is happening here. So I have a gold options. I have not bought physical gold. So at the strike price of 45,000, I buy a call, and at the strike price of 45,000, for the same strike price, I also buy a put. But because I am buying, I have to pay a premium. So I'm buying a call, I pay 150 premium. I buy a put and I'm paying another 150 premium. Okay, so let's see how this pans out. So let's get the premiums in. So 150 plus 150. So that is, I'm getting 300 rupees premium that I've paid. So I pay 300 rupees premium, and I bought a call at 145. At 45, and I bought a put at 45,000. So I bought this. Now let's finish the payoff table. I have bought a right to buy at 45,000. If the market price after 1 month is 45,700, what happens here? I have a right to buy at 45. If I go to the market, it's going to cost me 700 rupees more. So I will exercise my right to buy at 45,000. How much money do I make here? 700 rupees. I have a right to buy at 45,000. Market price is 44,300. Will I exercise my right and buy from you at 45,000? Of course not. Instead, I will go to the open market because market price is 44,300. So at 44,300, I will not exercise my right. At 44,500, I will not exercise my right. 44,700, I will not exercise my right. But at prices above 45,000, the higher it goes, I will exercise my right and buy from you at 45,000 because the market price is higher. Now let's look at the put. What is a put? Right to sell. Right to sell at what price? I have a right to sell at 45,000. How did I acquire this right? I acquired this right by paying you 150 rupees premium. So I have a right to sell at 45,000 rupees. If the market price is 45,700, will I sell it to you at 45? Of course not. I'll be happy to sell in the open market for 45,700. If the market price drops to 44,300, will I exercise my right? Yes, I will. Because if I sell in the market, I will only get 44,300. So I will exercise my right and sell it to you at 45,000. If the price drops to 44,300, I will exercise my right. How much money do I make here? 700. So if you look at the payoff, it looks something like this. So if you look at the net position, that means I'm adding this, if I'm adding them all, if I add the calls and the puts and the premiums, you can see what is happening here. So what is this basically telling me? This is basically telling me that if the prices drop, if the prices rise, if the prices they rise, the more they rise, the more money I make. And here on the other side, if the prices drop, the more they drop, the more money I make. And this particular strategy is also sometimes known as a strategy, what we call event-driven strategy. We call it an event-driven strategy. So basically what this is basically telling you is that I can buy a call and buy a put when I know that a particular event is about to happen in the future. And the impact of the event could drive the prices up or it could drive the prices down. So for example, now if I think that by September, we may get what we call a vaccine for coronavirus. Yeah. So we get a vaccine for COVID-19. If I'm assuming that we get, I don't know whether what's going to happen. So, but suppose I'm waiting for an announcement on a particular date. Now, two things can happen on that date in the future. One would be that they will say, hey, we have found the vaccine. The other option could be, sorry, we'll have to wait longer. We have not yet found the vaccine. Now, in such a case, two scenarios happen. Either the price will drop or the prices will go up. Okay. And whichever direction the price moves, the more it moves away from the center, the more money I make. And hence we call it a straddles strategy. We call it long straddle. If you notice, we call it long because I'm buying a call and buying a put. The minute you buy, then we call it long. If I had a strategy based on selling a call and selling a put, then that would have been called a short straddle. Okay. And it's called a straddle because we trade at the same strike price, exactly the same strike price, 45,000, same contract, and hence we call it a straddle. If these prices, if I had bought a call at 45,000 and if I had bought a put at say 45,600, because they're of different prices, then it would have been called a strangle. Otherwise, generally the strategy is the same. Now in commodity markets, where do I use a straddle? So for example, I am a user of a commodity called copper. Okay, so I'm looking at copper, prices of copper. Now copper, by the way, is the largest producer of copper is Chile in South America. They produce something like almost about 35% of the copper in the world. They produce it. They have mines for it. They have copper mine. And recently it happened that the mines in the Chile copper mines, they had gone on a strike. This happened sometime about more than a year ago, when they had gone on a strike. So when they went on a strike, what happened? There was a reduction in supply in the markets. So when supply falls, price starts going up. Now, there was an announcement that there was going to be a meeting between the mine officials and the government of Chile. The meeting was to resolve the strike. They wanted to resolve all the problems that the miners were suffering, and there was a meeting expected to resolve the problems. And the outcome of that meeting could have been two. One, they would have been amicably settled, in which case the miners would have resumed work. If they resumed work, they started producing copper, If they started producing copper, supply would have gone up and the prices would have fallen. The other option would have been that the mine union and the government did not see eye to eye. They continued their fight, in which case the strike would continue, in which case there would be a shortage of copper and the price would start going up again. So the point here is the event was the meeting of the mine union and the government. Outcome, we don't know. It could have been any way. It could price going up or price coming down. Similar kind of situations we see in the oil market as well. Not now, but right now during the pandemic, things are different. But generally, many times we see that in the OPEC countries, the OPEC are the oil producing countries, mainly from the Middle East. Many times they have meetings, and in the meetings they decide as to how much oil that they wish to pump out per day. So they talk about 1 million barrels of crude oil. Some other country says we will take 200 million barrels of crude oil per day. Yeah. So they decide and they allocate as to how much crude oil a country can extract from the earth. And they do that because they don't want to flood the market with too much oil. So they give quotas to each country as to how much oil they should extract, right? And many a times the rest of the world is watching. If all the countries agree to the quota, then what happens is there is a supply crunch, in which case prices start shooting up. But if there's a dispute amongst the countries, like we saw recently, maybe a few months ago, when Iran, which was told to produce less, but they said, why should we produce less? They said, all these years there was an embargo on us and we were not producing anything. And so now we are not going to produce less, we are going to produce more. And it created a dispute. And when that such kind of a dispute happens, then all the countries just walk away from that meeting. And with the result, every country starts producing whatever they feel like. And then there's a glut in the market and the prices start falling. So I can design a straddle strategy on a crude oil, not on a gold contract, on a crude oil contract, where I'm waiting for an event which will take place 15 days or 1 month in advance. And then I'm waiting to see the outcome of that meeting. If everything is settled amicably, then the price will go up because they will have agreed to cut down production. If they keep fighting amongst themselves and each country produces more and more, there's going to be a glut, in which case the prices will fall. But then I, as someone who has designed and implemented a straddle, I'm indifferent to the outcome of the meeting. Whichever direction the outcome of the meeting takes, I will still make profit. If the price goes up, I make money. Price goes down, I make money. As long as the price is not stagnant, in case the price is stagnant, then I end up making a loss. But otherwise, I'll make money. So if you look at this, the example I just gave you was a long straddle, where I buy a call and buy a put. We can also have a short straddle, sell a call and sell a put. Yeah. Then we can have a strangle. These are different strategies, like a strangle strategy. So I buy a call, buy a put, but with a different strike price. Like I told you earlier, that if I buy a call at 45 and buy a put at say 45,100 or 45,600 or whatever. So if I'm buying both the contracts at different strike prices, then we call it a strangle. But if I'm buying a call at one strike price, buying a put at a different strike price, we call it long. If I'm selling a call at a different strike price, selling a put at a different strike price, we call it a short strangle. So in the combination strategies, these are very commonly used strategies. And they normally, if you implement it or in a proper sense, if you have a very good understanding of an event which will have an impact on the prices of commodities, then such strategies will definitely bring some value to your bottom line. Now, we also have something called a spread strategy. Okay. Now, remember I said that in options, you can have thousands upon thousands of strategies. So we can make strategies and we give them names. Sometimes we take these strategies and put them into some context so that it becomes easy for us to follow up on it. And we make it some sort of in an academic way. We put them in some sort of a structured format. So, for example, we have we trade, we have an underlying security is same. That means I choose a commodity contract like silver. So on a silver commodity on silver for the same expiry, That means one particular contract for a same commodity called silver, for example, at different strike prices. That kind of a strategy would be called a vertical spread strategy. Yeah. If I have for the same commodity but different expiry month, that means I have two different contracts, one contract ending in August, another contract ending in October. So on two different contracts of the same underlying. So I'm playing on, say, copper contract, August expiry, copper contract, September expiry, two different contracts of expiry, different contracts, but the same underlying copper, but at the same strike price. Now that would be called a horizontal calendar spread. Okay. Similarly, I can have a diagonal spread. When I have the underlying security is again the same, but expiry month is different, strike price is different. So if the strike price is again different, so we call it a diagonal spread. So we can have different kinds of, for each of these positions, each of these situations, I can actually make different kinds of payoffs like of this nature for each of these strategies. In fact, for all those 1,000 strategies I talked about, we could do that. So we can, let me look at another strategy here. We have other strategies like bull spread strategy, bear spread strategy, bull spread using puts. So here we have bull spread using calls, bull spread using put. I can have bear spread using puts, and you can have bear spread using call. So different strategies here. Now, I'm going to do two of them for you right now. I'll say a bull spread using call, okay, and a bear spread using put. Now, what I'll do is, because of time, we will combine both these strategies. So we'll a bull spread using call, bear spread using put. We can combine these and we can create something called a box strategy. Yeah. So in a box strategy, for example, is a combination of a bull call spread and a bear put spread. So I'm basically bull call spread and a bear put spread. So I can combine both these and I can create a strategy. Like I already told you, in derivatives, options traders, they consider themselves to be on a different level because they can do so many more things from the strategy point of view. Now here, for example, I'm buy a call at 28,800. So because I'm buying, I'm paying. How much am I paying? I'm paying 135. Why am I paying 135? I'm paying 135 because I'm buying a call. I sell a call at 29,300. There's a strike price. Because I'm selling a call, although it's in brackets, don't get confused. The 61 rupees is the money that you're receiving because you are selling a call. In a put side, I sell a put at 28,800. Because I'm selling a put, I'm receiving 65. And if I'm buying a put at 29,200, I'm paying 142. So 135, I'm paying. 142, I'm paying. 61, I'm receiving. 65, I'm receiving. So if I add all these premiums together, net premium paid is 151. Now, I can, all this kind of a situation, I can put it in a payoff table. It'll look something like this. Now, here what is happening is that you can see that I buy a call at 28,800, sell a call at 29,200. And similarly here, I can say at 28,800, I have a call. At 29,200, I have a put. So then I look at what the future price is going to be. So whatever the future's price, it will have an impact. And the impact in a box strategy, you can see whichever direction the price moves, the payoff strategy is I will make money. And it doesn't matter what price is going to happen in the future, the money I'll make is exactly the same. The payoff strategy gives me the same kind of absolutely same money. Yeah, it's an arbitrage kind of a strategy where it doesn't matter what happens to the price movement, I end up making money. So this is an arbitrage strategy. Now, if just to give you an idea of what we have done here, I'll just explain with one or two of them. Yeah, and rest of them you can try it out yourself. So I have a buy call at 28,800. Yeah, so at 28,800, I have a right to buy. For this right, I've paid 135. 28,100. Right to buy at 28,800. So if the market price is 28,500, then I will not exercise my right. I'll walk away from the deal. And what is my loss? My loss is the premium paid. If the price becomes 28,900, Yeah, and can you see that 28,900? If the market price is 28,900, I have a right to buy at 28,800. But if the market price is 28,900, I will exercise my right. So how much money do I make? 28,800 minus 28,900, which is $100. How much money have I paid? I have paid 135. So what is my loss? My loss is now reduced to 35. So let's look at one more position here. I have a right to buy at 28,800. If the market price is 29,500, then how much money do I make? I make 28,800. Yeah, 28,800. I have a right to buy at 28,800. Market price 29,500. So 28,800 minus 29,500 less the 135 that I've already paid you. So I come with 565. So this is how I have a payoff table for this particular position. Which position? This very first one here. So let's take one more. Let's take a sell put, for which I have received 65 rupees, 28,800 sell put. So if I look at sell put, here's a sell put 28,800. I have a 28,800 sell put. What is sell put? A put is right to sell. Sell put is forced to buy. Someone will force me to buy at 28,800. Will anybody force me to buy at 28,800 when the market price is 29,500? Of course not. Nobody will force me to buy at 28,800 when that somebody can sell it in the open market for 29,500. And hence the 65 rupees I have received as premium is all my money. However, if the price drops to 28,500, if the price drops to 28,500, yeah, if the price drops to 28,500, someone will force me to buy at 28,800. So the difference between the two, 28,500 and 28,800, whatever the difference is, 300 rupees. Yeah, that's 300 rupees minus the 65 which I have already received as premium is 235. So you can see here what is happening. So what is happening here is that for each of these positions, I can now decide as to whether I wish to exercise or not to exercise. But whatever I do, the end result is that I end up, when you add them all together, you can see that I end up making money here. This is called a box spread strategy, where I'm using all the resources I have and I'm using all of them and designing a strategy. So what I've done here in this particular strategy was I joined a bull spread strategy and along with the bear spread strategy. So I have 4 positions that I took: buy call, sell, put, buy put. 4 positions I've taken, and when you put them together, it doesn't matter which direction the price moves, I end up making money. And this is an example of a vertical spread, bull spread strategy. Okay. Now, one more thing that I need to talk about now is what we call options on futures. Now, options on futures is very important because on the commodity exchange, at MCX, the contract that we have is what we call options on futures contract. What it means, and the reason behind this is that when the regulator asked the exchange to launch commodity contracts, commodity options contracts, they said that these contracts must be deliverable contracts. They cannot be cash settled contracts. They had to be deliverable contracts. And how do you make them into a deliverable contract? So what we did was that the contracts were based on the futures contract. So all these contracts that you can see, the gold options contracts, silver options, crude options, copper options, zinc options, all these options contracts, they all expire a few days before the expiry of the futures contract. So you have a 1 kilogram gold contract expiring a few days before the expiry of the futures contract. So the options contract, when it expires, it converts into a futures contract and you take delivery as per the contract specification of the futures contract. And hence, because all these contracts expire and convert into futures contracts, they are called options on futures. The contracts that we have, commodity options contracts that we have in India, they're all options on futures contracts. Okay. And hence what happens is once your position converts into an options contract, once your options position converts into a futures contract, then you have to follow all the rules which are there for the futures contract. So all the future contracts rules and regulations at the time of expiry of the futures contracts become relevant to all the option contract holders. Now I'll give you one example of when this is becoming relevant. An options buyer, call option buyer, a put option buyer, he pays a premium, and the premium is transferred to the seller or the writer. Now, if this options buyer, that means a buyer of a call, and options buyer of a put, if they want their position to convert into futures so that they can give and take delivery, then at the time of conversion, they will also be asked to bring upfront a premium, just like in futures contracts where premiums are paid by both the buyers and sellers. Here too, the minute your position has converted into options, from options into futures, then you become a futures trader, and hence you too are expected to bring margin money to the extent of your position. And hence the buyers of calls and buyers of puts are expected to bring the premiums at the time of expiry if they want to take a delivery on the futures platform. The sellers, the writers of call options and the writers of put options, they are always premiums are taken from the margins are taken from them, because the exchange will guarantee the delivery of a contract, and hence the writers of options, they from day one, premiums are applicable to them. So there's not as much bit of a problem for them. The problem comes only for the buyer of call and buyer of put. So hence there is in addition to these 5 contracts that we have also launched about 2 weeks ago options in mini contracts, because you can see here we have a 1 kg gold and 30 kg silver. So now we have launched a mini contract for gold and a mini contract for silver. So these are very small. This you can say it's a 100-gram contract. The mini contract is a 100-gram contract, and the silver mini is a 1 kg bar. Yeah. So we have got a 5 kg contract. So silver contract is small. So we have got different types of options contracts for catering to different types of people. So here it's about the devolvement that takes place. So the whole idea here is about devolvement. That means if you are not squaring up your position, if you trade in gold in a commodity options contract and you have not squared up your position, and I'm talking here about the writers of the contract only, if they don't square up the position, then what happens is all the long call holders, they convert into long in futures. Long call, what is a call? Right to buy. Yeah? So is a long call, his buyer of a call is called a long call. So buyer of a call who has a right to buy, his position devolves into a long in futures, a right to take delivery. He wants to he's a buyer of a futures contract. Long put, he gets into a short in futures. Short put becomes a short in futures, and a short put becomes a long in futures. So these are the devolvement that take place at the time of expiry of the contract. So this devolvement happens if somebody is trading in options and wishes to take or give delivery. That is only at that point in time this devolvement exercise starts, and it happens at the expiry of the gold options contracts. So that is why we call it devolvement, and there's a devolvement timeline. For example, if I have a contract ending on the 24th, then the exchange will tell you 4 days before, 4 working days before, that they send you a sensitivity report telling you how much margin you need to bring. Because remember, the options buyer, the buyer of a call, buyer of a put, he has not paid any margin. He has only paid a premium. But now, because his position is converting into a future, he needs to bring in the margin money. So he's warned 4 working days before, please, how much of margin money he needs to bring. And the last trade that anyone can do this be at, like, say 11:30 p.m. or 11:55 p.m. depending on the time of the year. On the 24th, the day of the expiry of the contract will expire at 11:30 on the 5th of October. Yeah, and then there's explicit intimation. You can give an intimation to the exchange saying that, hey, convert my position from options into futures. So we give the exchange will give you 3 days, 22nd, 23rd. So 3 days, 3 complete days are given to the options player. He can now give instructions to the exchange saying, hey, I want my position to be converted into a futures so that I can take delivery. And the minute he is doing that, he has to bring the money. What money he has to bring? Margin money. So he brings 25% of the margin money on 2 days prior to the expiry of the contract, or so 1 day prior to the expiry of contract, 50% on the day of the expiry of contract, and 25% in the morning of the day preceding the day, the following the expiry of the contract. So that on the 25th morning, an options trader will have in his account the margin money required, just like any other futures trader. Okay, and then if he stays on with that contract up to the end of the contract, the futures contract will expire on the 5th of October. On the 5th of October, he can take delivery. But even after converting his position into futures, he still have 5 days in which he can still, if he wishes, reverse his position. He can still sell that options position, that futures position that he has. So just to wind up again and to sum up again, he had an options position which has converted to futures, and now the futures position will end on the 5th. We are already on the 25th of the previous month, and if he wishes, he can still exit that contract, yeah, by squaring up his position. So he can still square up his position, and the margin money that he has paid will all be refunded to him. And so there is an entire devolvement timeline and calendar for that, for every contract. And this is the kind of contracts and options that we have. But generally, people who trade on options, you have a choice. You can take delivery, or if you're not interested in taking or giving delivery, then you can square up your position. And here, we are specifically talking about the writers. So this is the entire process, the mechanism. We'll not get into the mechanism of devolvement, but I'll end my session here, and I'll leave time for questions now. Hello, can we take questions?
Sir, thank you so much for providing valuable inputs to the participants, sir. We are extremely inspired through your information. Now I will ask the questions here, sir. So there is a question.
Yeah. Yes.
Madhusmita Malik. There is a question from Madhusmita Malik. Madam, Madhusmita Malik, madam.
Hello.
Hello, madam.
Yes, sir.
Yeah, we can hear you.
Please ask question to our speaker, madam.
Okay, sir. Thank you, sir. Namaskar, sir. My name is Madhusmita Malik and I am from Odisha. I want to ask that you have said about the buyer of the call or put option and seller of the call and put option.
Correct.
If buyer at the same time buyer loses and seller gains something, why this contract made?
You must remember that these are all 4 different positions that you have taken. So you can be a buyer of a call, that's one position. Seller of a call is another position. Yeah. And whenever you're trading in options, you can take as many positions as you want, whichever position. In the same contract, you can be a buyer and you can also be a seller at the same strike price. So what is the difference? So suppose at 5,000 rupees, I buy a right to buy at 5,000 rupees. I also buy a right to sell at 5,000 rupees. So what is the difference? The difference is the premium at which I've entered the contract. Okay, so that is what the question is.
Okay.
Thank you, sir.
Okay, thank you, sir.
There is a question from Dr. Nagarjuna B.
Yes,
sir. We will unmute him. Sir,
Good evening, sir.
Yes.
Sir. Good evening. Good evening.
Please
Thank
ask
you.
him.
Good evening, sir. Srikanth Kaundinya garu.
Good evening.
This is Dr. B. Nagarjuna. This clarification which I need is related to the clarification given by you in the morning session for my question on impact of COVID-19 pandemic and derivative market.
Okay.
And I thought of getting clarification in the morning session itself, but due to time constraint, I could not continue it.
Okay.
Whether it is a future contract or option contract, as you said, as we know, derivative market is basically based on the perception and the perfect information related to the supply demand.
Correct.
Sir, you told in the morning session that the commodities like onions, ginger, turmeric, pepper, garlic are not included in the multi-commodity exchange traded. My question is why these commodities are not traded in multi-commodity exchange list? First thing. Second thing is the pandemic has taught new lessons to all the sectors of the economy, and multi-commodity exchange is not an exception to this. Yes. At least because in the next few years, till we get a standard, perfect and reliable vaccine into the market, it may take a couple of years or even 10 years to get a perfect medicine, just like we have today a medicine for polio, a vaccine for polio. Absolutely. So till then, there will be a huge demand for these products like commodities like ginger, turmeric, garlic, onions, pepper, etc. Both by pharmaceutical companies as well as in the domestic consumption. Today, if you go to any local market, we observe how people are purchasing this ginger. And how there's a lot of trading, what called deviation we have observed, particularly in these commodities. At least in the coming days, what is the stand of multi-commodity exchange? Is there any possibility like these products will be traded in multi-commodity exchange? Please let me know, sir.
Okay. Now, two things here I must tell you that I had mentioned about a list that the SEBI has, okay? And turmeric is there in that list, I know. Also ginger is there in that list, I think. Yeah. Now the thing is, it is a management decision because these are all private exchanges. Okay, all exchanges are private exchanges. So it is a decision that the exchange takes whether they wish the contract to be launched. Now, what is the decision making here? It's based on a perception of the demand and a supply, and that means, let's just put it this way, buyers and sellers for that commodity. So that means the members of the exchange or the members' clients, how enthusiastic are they in trading in this particular contract? That is the question, right? If you do not have enough number of buyers for that contract, or you do not have enough number of sellers for the contract, then the contract becomes a failure, okay? A failed contract is not a nice thing. I had said in the morning that what is the product of an exchange? The product of an exchange is a contract. It's like if a car manufacturer manufactures a particular model of car and no one is buying that model because it is outdated or it has got a defect or it has got some problem. And then it becomes a black mark on that auto company because they have designed a product, a car, which nobody wants. Similarly, in the commodity market, the contract has to be designed. Designing is one part. The other one is it has to be made popular. We have to see the marketability of that contract. We have to see whether the market acceptability of that contract. If people don't trade in that contract, then the contract becomes a failure, becomes a failed contract. And hence, the management of exchanges do their own research, because someone in the morning had asked about research. This is the kind of research that is done. You do research to find out what kind of acceptability would be there for a particular commodity if we design a contract and launch it. Yeah. So it's a very important point. This is a very important thing when at the time of launching a contract. Now, when you talked about COVID-19, I hope that it doesn't take 10 years. I just hope that we come out of this very, very quickly. But yeah, we keep our fingers crossed and we hope that we come out of it very, very fast. But whatever. The thing is that from a commodity point of view, prices are impacted by various factors. And we from the exchange, we look at COVID-19 as one such factor. Okay. In other words, it could be rainfall. Rainfall comes and destroys a crop. Okay, it can be this pink ball worm which destroys the cotton plantation, or it can be flooding of a mine, or it can be COVID-19. It doesn't matter. From my point of view, as a hedger, I hedge my risk. because I am hedging against something that I cannot control. What is it that I cannot control? I am not able to control the future. And that is why I'm hedging. Okay. And so the exchange, as long as there's risk caused by COVID or anything else, you have an instrument for hedging that risk, because hedging is not about making money. Hedging is about mitigating risk. So who is making money? It's the speculator. How is the speculator making money? Because he's a day trader, or maybe a weekday trader, or a short duration trader who is trying to make money on the small movements in price. Okay, and hence the people who are taking the risk, the investor who is trying to take a risk by small movement in price, is helping the hedger to overcome a possible loss. And the person who is trying to overcome the possible loss in the physical market, his aim is not about making money. His aim is definitely not about losing money. His aim is to mitigate risk. And hence, COVID-19 or no COVID-19, exchanges are there to stay. Exchanges will grow as long as there are people who will manage their risk and who see the exchanges as a solution to managing that risk. And going forward, whether we find a solution in 5 years, 10 years, 1 month, 3 months, it doesn't matter. Risk is there. I'm going to mitigate that risk by coming to the exchange. In fact, just to tell you, after COVID-19 has come, the volumes on the exchange have grown. And one of the reasons is, I'm sure it is because people are, there are two reasons, of course. One is because people are sitting at home and trading on their laptops and on their mobile. And the other reason is that many companies who are using these commodities, they are managing the risk on the commodity exchange. So hedgers have also come on board. Okay.
Thank you, sir.
Yeah. So any questions?
Sir, there are some questions from the chat box, sir. Yeah. YouTube chat box. The first question is from Dr. Surendra. His question is, can you please throw light on the gold futures options that are going to start from 24th August?
I see. Okay. The contract which is being launched on the 24th of August, that is what we call it's a bullion. We call it bullion futures. Okay, it is an index futures. We call it index futures. So basically, like when you trade on say Nifty, when you're trading on Nifty or you're trading on Sensex, what exactly is Nifty? Nifty is a amalgamation of 50 scripts. Okay, in those 50 scripts, you have cement stocks, you have IT stocks, automobile stocks, you have manufacturing companies, you have chemical industries, you got different industries, and each of these industries is given a weightage. So they pick good companies from that particular industry and to form part of the 50, and then they're given a weightage and they form the index. And then as the trading takes place in those scripts, then the index also keeps going up and down. And in fact, index is a good, it is a good indicator, not just to India, but for international markets as well, to show whether the markets are going up or markets are coming down. So if your index is going up, it is people say, hey, the Indian economy is doing well. Index is going down, the Indian market is not doing, Indian economy is not doing well. So these are indicative. Yeah. Similarly, in commodities, we have now going to launch on the 24th what we call index futures. It's first in the first commodity contract that we're launching in this particular segment, index segment, is a bullion segment. So what exactly is this? Now here we have merged two contracts. Which two contracts? Gold and silver. So it's a two commodity futures, index futures contract. Okay, and these have been merged in a particular ratio. The ratio, there's an entire way of calculating that ratio. It is a ratio of something like almost 70%, 30%, approximately 30% weightage to silver, 70% weightage to gold. And so if the price of gold and silver change, then the price of the index will also change, right? So if somebody has to if someone, and this is a cash settled contract, you can't take delivery. It's an index. There's no delivery in the index. So in an index, the whole focus is on trying to make money on price changes which are taking place on the indices. Now, this is the first one in the series. Next, we're going to come out with the metal index. The metal index will be a mix amalgamation of 5 commodities: zinc, lead, copper, aluminium, nickel. 5 commodities. Yeah? So it's a 5 commodity index. So it's a metal index. So basically the index will show what is happening in these 4 segments. Yeah, this particular segment, base metal segment. And that will come out later on during the year. So we are actually, eventually we will have a separate index for energy. We'll have a separate index for agriculture. And then we're going to combine them all of them. And then we will create something called a composite index, which will be a composite commodity index for trading purposes. But do remember, these indices, they are cash settled and they're very low value. They have low value contracts, and hence it is people, it will be acceptable and it will be within reach of all types of traders. Unlike our 1 kilogram gold contract, which is a 1 kg gold at today's rate is approximately 50 lakh rupees. And the 30 kilogram silver contract, its value is almost about 70,000 rupees, yeah, per kilogram. And hence, the point of the matter here is that you can actually trade on a smaller index value. So it's affordable to smaller participants. So 26, we are launching this. There's a lot about it is there on our website. So do go to a website of MCX and just check out index futures, and you will find, in fact, the entire work, the methodology is a very interesting information for the teaching community and for the academicians to go and look at how these indexes have been prepared. Because it's something that you can also introduce in your courses so that students will know how indexes get prepared. Once you understand how indexes are prepared, it doesn't matter whether it's a stock market, commodity market, whichever market, India, abroad, whatever. So you should have an understanding of how indexes are prepared, how they're maintained, how they're managed, and all that kind of a thing. So all that information is there on the website. So please, I urge all, especially the students, go to the website and check it out. Questions?
There's one more question from Mr. Dr. Narayana Gaud. Hello, sir. Am I audible?
Yes,
yeah, audible.
Proceed.
There's a question from Dr. Narayana Gaud. His question is, how many strike prices are given in case of index option as per exchange?
No, at the moment, we are not launching index options. We are only launching index futures. We don't have index options at the moment. So on the 24th, when we launch, it's going to be index futures.
Okay, sir. Okay, the other question from the same person is, what type of options are useful in different situations so that investor can get gain from this trade?
Okay, see, we have options. See, there are different ways of looking at this. What is the investor looking at? Investor is looking at trying to make money. But let's be very honest about it. Yeah, the investor is looking at from the point of view of making some money. So what gives him an opportunity to make money? It is volatility. If prices are very stable and they don't change, then the chances of making money are low. If the prices are very volatile, then you can use your mental capacity and try and find out what is causing that movement. And if you can get to the bottom of it quickly and you can implement it faster, then you have a chance of making money. So volatility is an important criteria when you're deciding on which commodity to trade on. Now, having said that, when the exchange launches a commodity contract, it does look at volatility at the time of launching of the contract. So we also have done our groundwork and our homework, and we have ensured that wherever we have, whichever commodity contracts we have launched in options, that they have a reasonable amount of volatility. And if there's no volatility, then it doesn't make sense to launch a contract. Okay. And also, of course, whenever you launch a contract, there's an entire research which is done behind the scene research which is done to ensure that that contract is successful. Yeah. So just like in the automobile segment, you do a testing of a car, we also do our testing. We have something called mock trading as well. So people do mock trading and all kinds of things to see if there are no glitches in the system. We try and find out, we get a feedback from the market to see how, what is missing. And then we try and, patch up those missing items and make it a solid product called a contract. Question?
Any questions from Saravanan?
Sir, one more question, sir, from Mr. Prabhagar Nandru. His question is, sir, what is the basic difference between application of binomial and Black-Scholes models to calculate option price?
Now you're getting very technical. So there are basically, you are using these statistical tools to arrive at futures price, an options value. That means premium. You're trying to find the premium value. Now, we had a problem with Black-Scholes in the sense that it would not accept negative pricing, negative values. So Black-Scholes was based on a criteria that prices will never go into negative territory, but we were proved wrong. In April, I think it was April 28th of this year, crude oil prices on the WTI contract went into negative territory. So there are sometimes flaws we have discovered, for example, in the Black-Scholes, which was not able to take negative pricing, and hence, and such times your binomial, the other tool came in handy. So it's choices. These are different choices which are given to the trading community, especially the sophisticated trading community, who wish to use these products to identify what the premium may be, should be, could be, based on the usage of these, the software, the two softwares that we talked about. Now, after having calculated it, the next problem comes in implementing it. So whether you are able to get that kind of opposite position at a particular given premium that has been arrived at using these tools, that is a different part of the question. But to answer directly to your question, yes, we had a problem with the Black-Scholes model because it wouldn't accept negative pricing.
Saravanan, is there any question?
No, sir, there are no more questions, sir.
Sir, Gunnar Nath, sir.
No questions. We can go to the ending.
Sir.
Can close it.
Okay.
It is mandatory to propose vote of thanks, sir.
Okay.
Gunnar Nath, sir, is an expert in subject. Is a diamond.
Oh.
Is a diamond with regarding the subject. Sir, everyone, sir, I have received from my friends who are working in other colleges. They said that your explanation given a separate path to teach the students.
Good.
They are asking me whether he is a professor or vice president of that MCX. Such questions they are asking me. No, sir, you are a great teacher also, sir.
Oh, thank you very much.
Okay, sir.
When people ask me, what are you? I of course, I gave you in the beginning of the program in the morning, you said that, you read out what I had given you. I said that I'm a chartered accountant and all that. But when people generally ask me, what are you? I always say I'm a teacher, and I'm very proud to say I'm a teacher. Very proud of that.
Thank you, sir. Teaching community would become happy.
Feel proud.
Yes.
Yeah, feel proud, sir.
Right.
Sir, Gunnar Nath, sir. I'm hand over to Gunnar Nath, sir.
Okay. Kaundinya, sir. On the other day, when we have conducted webinar on entrepreneurship, the speaker motivated to make students, instead of job seekers, they are motivated to become job providers.
Okay.
I am sure today, with your motivation, students not only they will think of job providing. They'll also become money spinners, sir. Definitely their way of thinking will change. They'll set their own way to move into these platforms, and they feel very happy that these are the avenues also they can think of it. Sir, let me be honest, many unanswered questions you have thoroughly answered us. In the money, at the money, out of the money, selling put options, buying put options, and also you made it very clear about all these aspects, and futures and options, the differences very well you have covered, and various strategies you have really explained in a nice manner. There is a saying in Sanskrit, Yam labdva aparam labaha. What is going to derive a benefit? If you know that, that itself is a great benefit. So you really made us to understand different strategies. Ability to make a right decision at right time is the key aspect in any future markets or option markets, sir. It comes only with meta thinking, critical thinking, analytical thinking. Only a right thinker can make money, sir. And this inspiration, only we can put it into practice to know, to earn, to move forward. So this is only a theoretical aspect. And really to earn money, one should enter into the market with small investment. Once if they experience, with their experiences, definitely they can make more money, sir. Once again, let me be thankful to you because you are associated with Vidyaniketan family for the past 3-4 years. Let us continue our association for future also. And once this pandemic situation is over, next coming year, we'll organize in a big way on big platform such that we can feel very happy offline. And let us pray God very soon. It is going to become new normal. Thank you very much. Thanks a lot.
Thank you, everyone. Yeah. Thank you.
Saravanan?
Yes, sir.
I request Mr. Saravanan propose a vote of thanks.
Oh, thank you very much, sir. Good evening, all. This is Saravanan K, Assistant Professor, Department of MBA, Sri Vidyaniketan Institute of Management. On behalf of Vidyaniketan Institute of Management, I take this opportunity to propose vote of thanks. We thank everyone who helped us in organizing this webinar successfully. We express our sincere gratitude to our Honorable Chairman, Dr. M. Mohan Babu Garu, and to our young and dynamic CEO, Mr. Manchu Vishnu, for their continuous encouragement and support. We thank our management team for motivating us to organize many more events like this. Special thanks to our resource person, Mr. Srikanth, Assistant Vice President, MCX Mumbai, for providing valuable insights on commodity market and enriching our knowledge. Thank you very much, sir. I would like to thank our beloved director, Professor N. Gurunath Naidu, for his enthusiastic support. I thank all our faculty, non-teaching staffs, and technical team for extending their support and cooperation. We express a special thanks to Mr. Munishankar for supporting us technically. We appreciate Dr. Sheikh Karim and Dr. Ujwala for extending their fullest cooperation for organizing this webinar successfully. Last but not least, our heartfelt thanks to our participants from all over India and abroad for their active participation in this webinar. I once again thank each and everyone who supported in organizing this webinar successfully. Thank you.
Please share about the feedback link. Saravanan, feedback link shows. Feedback link shows. Please share.
Feedback links actually are shared in all the WhatsApp groups. It is also shared in the YouTube chat box. The feedback link will be available for next 30 minutes. So the participants are requested to fill the feedback. After 30 minutes, the link will be disabled. So please fill the feedback as quick as possible.
Thank you.
Thank you. Thank you very much. Thanks.
Thank you, sir. Thank you, sir.
Thank you, sir. Thank you, sir.
Thank you very much.
Thanks for all the participants for joining us. Thank you.
Thank you, sir. Thank you.
Thanks.
Sir, shall we end the session, sir?
You can end. Yes, you can end the meeting.
Munishankar, sir, can you please end the session?